Hello. Welcome to the channel. Let's talk about risk to reward in Pokemon investing. So I've been seeing a lot of content popping up recently saying things like you should buy this now or you should wait for this to go down before buying because everything is crashing. And as I'm scrolling through the comments, I'm seeing a lot of collectors and investors ask things like, do you think this is a good buy, or do you think this item will perform well in the future? And a lot of the content creators tend to give very vague answers like, oh, you should think for yourself and figure it out. They don't really guide you in that process on how to think for yourself. So that's why I wanted to start making videos in hopes of being able to help people make these decisions for themselves more easily. Hopefully you find value in this and it helps you out. So basically, what is risk to reward? So you might think, oh, I know what this is, right? But a lot of people don't apply this fundamental concept in their investment strategies. And I think if more people did, they would be much better off and their decision making would be much more clear. So we're going to go over what exactly risk to reward is and why it's important to understand when you're making investment decisions. This isn't financial advice. None of this is absolute. And you'll see what I mean by there's still a lot of areas that vary from person to person. How you take this is entirely up to you. Um, it's more of a discussion about investment strategy that can hopefully help you make a better decision. Okay, so let's use a super easy example first before we look at real examples with Pokemon products. Let's say you buy something for, you know, uh, $5, right? And you think the lowest it can go is 0, and the highest it can go is 15, or this is when you'll sell, right? So your risk here is 5 because you can lose all $5, or you can gain $10 and sell it at 15. So what you do is you put it in a ratio. So you put the gain over the risk, and that basically gives you the ratio. So here you have a 2.0 risk to reward ratio. So this part is entirely subjective. What is a good risk to reward ratio? If you're more risky or risk loving, what they call it, maybe your ratio is much lower, maybe 1.5 or maybe even 1.2, right? If you're risk averse, meaning you don't like much risk, then maybe 2.0 or higher, or maybe even 3.0 or higher, maybe even 4.0, right? Just depending on how conservative you are with your risk. For me personally, I think anything over 2 is good, but this part is entirely subjective. And this is something that you'll need to ask yourself and figure out. And so what this means, this ratio, for every dollar that you risk, you can potentially gain $2. If the ratio were 3, it would be for every dollar you risk, you could potentially make 3, and so on and so forth, right? With 4. And basically, if you think about it, with a 2.0 ratio, you only have to win your bet 50% of the time to break even. That's pretty good. In a 3.0 ratio scenario, you only have to win 33% of the time just to break even. So the higher the ratio is, the less often you actually need to win to be profitable or break even. And this is really important when you're deciding on what you want to put your money into, because if it doesn't work out, at least in the back of your head, well, if it did work out, I would have made a lot more. And if I keep applying, my strategy in the long run, it will work out and I will be profitable. And that's what's most important. Here's the thing. Sealed product, everyone knows over time, basically you can't really lose. Everything goes up, right? So this doesn't really apply there, but the main thing about that is you're missing out on opportunity cost. And we'll go over that in a later video. That's basically, if you have your capital tied up, you can't really do anything else with it, right? Because you have no more money. You're missing out on opportunities and stuff like that. So you can't do anything. You're stuck. If you're looking at singles and slabs, I think this concept will, apply more, because singles and slabs don't usually go up forever over time. A lot of them, usually plateau out or even go down. So if you're making, bets on singles and slabs, this is probably a good concept for you to keep in the back of your head. So let's look at a couple real examples here, right? So let's look at this DR booster box. I've been seeing a lot of people asking, is it a good time to buy this? I don't see the printing anymore. This is it. Should I get this? And a lot of the content YouTubers will tell you, they'll say, I'm not really comfortable buying this right now, but they won't tell you why. They'll just say, oh, it's too high, right? Everyone can understand that it's too high. But what does that really mean? So this is a real example of how you can use risk to reward here. So let's say the market price is 427. Okay, let's just say you get this. And this part is also subjective. You need to ask yourself, what is the lowest price that I think this booster box can go to? For some people, they say, well, Pokemon can go to 0, right? Some people might say it might go to MSRP, maybe somewhere in the middle. And there's also people who say, no, it's never going to go below 200 again because it's just too good of a set, right? We've heard all of this, So it depends on you. For this example, let's say I think MSRP is the floor. It won't go below that. So let's say it's 180, right? If you buy this at 427, right? And you say the floor is 180, you're risking $247, right? So then you have to ask yourself, okay, what do I think, or when do I want to sell this realistically? I'll make another video on this too, because you need to have a strategy, not only an entry strategy, but an exit strategy. Very, very important. Unless you're a pure collector and you never plan on selling anything ever, then, I mean, at that point, this video probably doesn't apply to you at all. If you ever plan on selling it, you need to have an exit strategy. Otherwise, you're never going to realize a profit and you're technically not profitable. You might be on paper, but you need to make sure that you have an exit plan. We'll go over that in a later video on how and why you need a strategy. So let's say, for example, you sit down and you go, okay, I think a DR booster box can go to 1,000. That seems to be like the general consensus nowadays. It's like, oh, eventually this box will be $1,000, right? And so if you bought this for 427, right, then your potential gain is 573. And we said earlier that your potential risk was 247 if it went to MSRP. So what you would do is you put the 573 over the 247. You're looking at a 2.3 ratio. That's pretty good, right? It's not bad, but what if you compared it to other things? So you have a set amount of money and this isn't bad. This means for every dollar you risk, you could potentially make $2.30. Let's look at another example here, though. Let's take this prismatic ETB, right? It's 130 market. So let's say the MSRP on this is 60, right? So potentially you're risking what? 130 minus 60. So, oops, 130 minus 60. You're risking $70 on this ETB, right? If it goes to MSRP. And if, let's say, what's a realistic goal here? A lot of ETBs nowadays have like a artificial ceiling at around what, like 400. Let's say you think it can go to up to 400 eventually. So 400 minus the 130, you could potentially make 270 per ETB, right? So you're risking $70 to potentially make $270. So you take the 270 divided by 70. That's a 3.85 ratio. That's a lot better than the 2.3 with the Destined Rivals. So you can see here that's almost double, right? So when you're looking at your capital and you're thinking, okay, how do I want to deploy this? You ought to be doing something similar where you calculate, you find an item that you like and you kind of calculate, okay, what's my entry, what's my exit, and am I going to follow through with it? You have to make sure you come up with a strategy and you actually follow it. You can't be like, okay, when it gets to 400, oh, actually, I don't want to sell it. Or when it goes to 70, I guess it's easier to hold it. You don't have to panic sell it right at 70, but you get the point. You want to stick to your strategy to be profitable long term. So say it gets to 400, you sell it all and you rotate it into, something cheaper, a new play or a new opportunity. You don't want to just be holding something indefinitely, right? Never seeing gains. So this ratio is a lot better, right, than the 2.3. So this, in my opinion, would be a better play given the entry and the exit. Whether or not it actually is, time will tell, right? Nobody knows. Nobody has a crystal ball. But you can see how you can basically use this kind of, concept and apply it to basically any product, any single, any slab, any sealed product. It doesn't really matter. It gives you a sense of, how much you're risking and how much you stand to gain from what you're risking. And that's really important. I mentioned earlier, sealed product, usually you don't lose. So there's not really much risk long term, but you do have the risk of tying up your capital. And if, profit is your ultimate goal, then that can be a big issue. We'll go over that in a later video, but I hope this helps. If you have any questions, leave it down in the comments. And thanks for your time.